Hello there, Erin Real here. I'm sitting down today with Alan Hess, Vice President, U.S. Fund Research, ISS Market Intelligence. Alan, thank you so much for being here.
Thanks for having me.
It's great to have you in studio. I'm going to dive right in. The Advisor Pulse series, let's talk about this to begin with. So can you give us an overview of what this is, what it measures, how you conduct your research, the nitty-gritty behind it?
Sure. So the Advisor Pulse series touches on a variety of topics affecting the asset management and wealth management industries. We've had some that are, on novel and burgeoning issues. We did some last year on the spring's market volatility and the advisor's use of AI. And there are others that we have that are more recurring mainstays that we try to touch on every year. This one on vehicle preference is one of those. It's critical to have this data on portfolio construction on a trended basis. We interview thousands of advisors throughout the year on the Advisor Pulse research and other research with ISSMI, trying to understand the specific asset managers they work with, how their advisors organize their practices, what they're planning to change in the future. At ISSMI, we collect, distribute, and report on a large number of data sets on covering the global financial services industry. A lot of that captures critical data on how ETFs have grown, where advisors are moving, how flows compare year over year. But something that is critical about getting advisor sentiment data is how that can help asset managers and other parties understand the shape of future demand, because with advisors being the critical intermediary that they are between a less plugged in investing public and asset managers looking for customers for their strategies, their opinions can provide a better understanding of the path to success than potentially surveying their end clients.
And ISS was really kind of ahead of the curve when it came to ETFs still. There's this explosion in interest there. So your latest report, it really highlights the rising interest. And then you go into finding how advisors across different channels are addressing ETFs and different price points. Can you explain how that works?
Sure. So the growth in demand and interest in ETFs is occurring across channels. So we see that in plenty of our other reports. Our monthly highlights report, for example, found that 2025 was a record-setting year for flows for both passive and active ETFs. We recently discussed on our blog that 2025 was a record-setting year for new product launches, with nearly 1,000 active ETFs being launched in the market. In our report, when we asked advisors, assuming that the same strategy is available from one of your top asset managers as an open-end mutual fund, an SMA, or an ETF, which are you most likely to invest client dollars into? We found that 60% of advisors broke for ETFs, a clear majority, compared to 30% who most preferred SMAs, and at this point only 10% that are most likely to invest in the legacy open-end mutual fund. Again, that's occurring across channels, but there are some channels that are much, much more committed than others. For example, 80% of advisors working in RIA channels were most likely to pick the RIA, compared to about 60% of bank, independent, and regional broker dealers who most preferred the ETF. Wirehouses were the one channel that saw a preference for another vehicle, in this case the SMA, thanks to the higher prevalence of high net worth and ultra high net worth clients in their practices. But even they saw something like 40% preferences for ETFs. So there's definitely a strong, solid client base there. We asked advisors to rate a series of reasons that they picked ETFs, and again, cost was a key driver across both. Low fees were the most singularly important reason for advisors to pick ETFs, with 80% of advisors saying that they were choosing passive ETFs based on their low fees. Tax efficiency came as the second most frequently cited reason, the ability for ETFs to help deal with capital gains distributions. Now, when looking at active ETFs, those numbers were flipped a bit, where tax efficiency was the most singular important reason, which ended up being particularly prescient when it came to this past year, where active mutual fund investors were hit with larger than normal capital gains distributions. Low fees were, of course, also important to advisors who were interested in active ETFs, but that was the second highest reason.
I'm glad that you bring up cost because, this interest in low cost products, it comes at the same time that there's been incredible demand and growth and interest in alternatives. So how do you reconcile this essentially? And what are some of the implications for advisors in the space?
Something that we'll talk a lot about in our research is barbelling, where there's essentially these movements at the extremes. And that can definitely be seen here. You've got a situation where passive investment has very much raised the floor for performance that investors expect from asset managers. That being said, even with the focus on cost, on tax efficiency and low costs, when we were asking advisors to rank reasons for using ETFs, active management came in third for active ETFs. There are advisors and investors who are interested in paying for active management. They just need to be convinced that what they're getting is something that can't easily be replicated in a passively managed strategy. And related and other key takeaway from the report was looking at the vehicles that advisors were most likely to put additional dollars into over the next year. Active ETFs did come first at around 58%, but that was followed by direct indexing and alternatives, all which come with their own different audiences and client bases. Direct indexing, while there is movement down market, is very much designed for the higher end client who's going to need that help with tax management and other kinds of dealing with concentrated positions. And then really on the other end of the spectrum is alternatives, which may not be the core allocation and may come with a higher cost, but can be a way to help create diversification in a portfolio.
Alan, in your report, you highlight a lot of the persistent time pressures that advisors are under. So, how is this influencing their models, their outsourcing, their portfolio construction tools? How does that all come into account when trying to reveal what advisors want in terms of working with asset managers today?
But not only are advisors aging and having to take on more clients and just deal with a greater number of tasks, but they're operating in a more competitive marketplace where there are many other asset managers and other specialists who can focus on this. To shift to more of a life coach kind of role where the majority of their time is spent helping clients figure out their goals and how best to achieve them, that is going to involve more outsourcing of investment management. And that is something where models will come in. In our surveys, we asked advisors, what is the top challenge you have in managing your practice? And the time spent on researching investments was the largest one. Managing client expectations was second, which again, both of those emphasize the need to shift to that more holistic role. And models can really help address this. When we asked advisors what their top reasons for using models and model portfolios, the time that it helps them save on investment management was mentioned by the widest number of advisors. The one reason that was mentioned more often as the top reason was how models help advisors with fiduciary and compliance concerns. And knowing that these models can help address these issues when advisors are already working in such a complicated environment, dealing with different share classes and structures and figuring out how their practices align with something like regulation best interest, it's nice to know that the model can help handle that for them, and they can spend more time working with clients and really helping figure out what their goals are. We asked advisors, how they have a preference between working with an existing partner or a potentially new asset manager with a wider set of strategies and wrappers. And 3/4 of advisors chose to stick with their existing asset management partners. They're really trying to lean on those existing partnerships.
Good to know. Alan, thank you so much for your time and your insight. That was Alan Hess, Vice President, U.S. Fund Research, ISS Market Intelligence. I'm Erin Rael, and this is Asset TV.